Hi, I'm Chris,
And I'm Eli.
and we are the Landlord Gurus. We've been managing our own rental property for decades now, and we've created this show to share our experiences, tips, and best practices we've refined over the years. Thanks for joining us, whether you found us on YouTube or our podcast or at landlordgurus.com. Before we get started, just a reminder to like, share, and subscribe so you'll get notified when we put out new content. Hi there, and welcome to another Landlord Gurus podcast. I'm Chris, and we have Eli, the other Landlord Guru. And today we're joined by a very special guest, Justin Buehring, a residential lender with Highlands Residential Mortgage. Today we're going to talk about basically the overview and the kind of lending A to Z for any landlords who are currently in the market or need to think about it, as we all do, kind of coming up in the future. So both of us have known Justin for a long time. We've been friends. We both actually have worked with Justin previously with various services. I got a house mortgaged through him many, many years ago. And Eli, I believe you've done that too, and done some rental property with him as well.
Both a number of each. Yep.
So hi, Justin. Why don't you take a few minutes and introduce yourself to all our viewers and listeners as well?
All right. Thanks for having me. Good to see you guys. I've been in the industry for 30 years now, hard to believe, but we do residential lending, 1 to 4 units. And, my company is great. I mean, we close everything on time all the time, but there are a lot of complications with, doing a rental property that people might not be aware of that hopefully we can talk about, or if people have questions, feel free to give me a call and I can walk you through it.
Sounds great. Yeah, and we will put Justin's contact info here in the show notes so anyone can reach out to him as well. So let's, why don't we just get into it and kind of talk us through the differences between, I'm sure most of us are somewhat familiar with, taking out mortgages for our own personal homes. If you haven't done it for rental property, maybe you can walk us through some of the similarities and differences between the two.
Sure. So pretty straightforward on, buying a primary residence. Rates are a little bit lower just due to the risk on the mortgage itself, because somebody's probably more likely to walk away from a rental house than the house they live in. So rates are usually about 0.25% higher. And then there's usually a higher down payment required as well due to that risk. Best rates on a rental property are going to be 20 to 25 or 30% down. So each one of those is a little hair of a different rate. If somebody's looking to get started for the first time and get into owning properties, FHA is a wonderful way to go, because what FHA does, it allows you to qualify with the rents on the other units. So if you're buying a fourplex, you're going to use the 3 other units of rent for qualifying purposes. And then also the great thing about FHA is it's only 3.5% down required. So whatever the purchase price is, you can get into owning primary and 3 other units for 3.5% down.
So when you talk about using the income from the 3 other units, that's then with the assumption that you are living in one of those units yourself.
Correct.
Is that correct?
Correct. In order to go 3% down.
And that's a requirement with the FHA loan.
Correct. Exactly.
And what happens if you're buying a duplex or a triplex that doesn't already have established renters in it, where you don't have a kind of a paper trail of those rents to demonstrate to just, your underwriter, what the income is going to be?
Yeah. So that's an excellent question, Eli. There are different qualification factors, especially on rental properties, but typically you carry more weight, so to speak, if you have been a landlord before, and rather than just somebody getting right into it. But yeah, that's an excellent question. There are so many different factors in how you show your income on your taxes for rentals versus not having income on your taxes from rentals. But excellent question. But yes, there are different factors of qualification based.
And even still, it sounds like this is a great way for a first-time landlord to get in by buying a property that they can rent out. A second unit that's on the property, or it's third or fourth.
FHA, this FHA program. Yeah.
And conventional too. If you can qualify with your income and you have the payment, obviously that's a great way to get a little support for your mortgage. But rental properties around here are little pricier than some other areas of the country. So
Yeah,
Yeah,
exactly.
we're in Seattle, so one of those
Yeah.
expensive markets. So
yeah.
okay, Justin. So what if it's not going to be a residence that you are? So you already own your own home and you want to invest in a rental of some kind. And let's keep it at the 4 units or below, which
Right.
we'll touch on in a minute. But
Right.
a small plex or down to a single family. So
Sure.
what's it like to get qualified to buy a rental?
I mean, it's pretty easy. The down payment, again, you're looking at usually minimum 20% down. Best rates are at 30% down. But a lot of people, if you're buying a second home, I can qualify you within an hour. But a lot of people, what they do is we set them up with what's called a HELOC or home equity line of credit and put that on their primary residence so that they can use that for the down payment if they don't have funds, in a bank account or investment account. And then what that does is they can use that same HELOC if they have to fix up a rental place or get it ready for the market. It's just a nice thing to have always.
Do many of your borrowers end up carrying that HELOC for very long, or do they end up refining and rolling everything into the rental property later on down the road, maybe when there's a little bit more equity?
Right. And that's a great question. And I've had clients do both. I think it's very important if you've got equity in your home to have a HELOC on your house because it's emergency funds if you need it. Your engine blows up or whatever. But basically, yes, we've done both where they refinance it into their primary residence or at a later date and rates are better, they refi it into their rental. It just depends. It also depends, and they should consult a tax person, but it depends on how you file your taxes on which is the best benefit on how to do that too.
Because a HELOC will carry a significantly higher interest rate than a 30-year loan
Correct.
will, right? I mean, by a couple of percentage points generally.
Yes,
Isn't that
correct.
right?
Exactly. Mhm. And, it's interest only. And the reason for an investment property, it might be good rather than conventional loans because it is interest only payments and you only pay interest on the balance that's outstanding. So that way, if you have, remodeling to do on the rental, your payments are lower and you're not paying for payments that money you're not using.
Right.
Right.
So my first rental, I put 20% down and then I borrowed 15 back on a HELOC on that property. And then I did a bunch of my rehab on that. Those days are gone, right?
No,
Can
no,
you
as
do
long as
that?
you have
Can
equity
you do
in
that?
the rental property, you can still do that.
Right, and yeah, okay. So but that would mean that it would have to appraise at, 5%, you'd have to have that kind of 90 to
You have to have
95%.
20% equity to do that. Yeah. And if you're
Okay.
doing, a lot of times, if you're doing remodeling or things, the value goes up. And so there
Right.
are a lot of banks out there that allow you to do that for sure. And the nice thing about a HELOC is it is tax deductible as well, like first mortgage.
And that's a HELOC
Interesting.
on a rental or on your home or both.
Mhm. Yeah, but a HELOC generally is, again, it's up to the tax person that you're using, but generally it is tax deductible on both.
I see.
Yeah.
Right. Cool. So you had touched on briefly there about refinancing. Why don't you kind of walk us through some of the things to consider about like kind of when you might want to refinance and, sort of what factors are important. Obviously we're in a higher interest rate environment than a lot of people have been used to in the last, several years. So it may not be right for everybody right now, but at what point does it make sense to do that?
That's a great question too. So typically everybody says, well, you need to save 1% on the rate to refi, but 1% on 300,000 is really the same as 0.5% on 600,000. So what we do is we go through the figures. I'm not one of those people I make money when the loan closes. I'm not one of those people that's going to say, yes, let's refi, let's get this done. And there are a lot of companies out there, excuse me, that just want to make the dollar bill, right? But
They would encourage you to refinance like kind of all the time, or continue
no matter
doing
what.
that, right?
Yeah, no matter what.
But there's costs. But there's costs associated with that may not make it worthwhile for you to do that, for the borrower to do that for sure.
Absolutely.
Sorry, Justin, without getting too deep, what are a couple of those costs? Who do I pay? Where does my money go when I go to refi?
Good point. So there is a cost to our company. It's about $1,700. There's
Any
escrow,
lender,
appraisal. What's that?
any lender
Registers of
would have
deeds.
a fee.
The total on refi is really anywhere from $3,200 to about $5,200, depending on the price of the refi or the loan amount.
Uh-huh.
So
Gotcha.
yeah.
So that's definitely a consideration to keep in mind.
Yeah.
And, might not lead you to refinance as much as some of those lenders out there would encourage you to do.
Yeah, it's almost crooked. There's so many out there now that are call centers that really don't know much about the industry. They're just there handling phone calls and passing them off to the masses. But I'm taking a lot of different classes. I'm a certified mortgage advisor. Whoop whoop. But I've been here 30 years because I take care of people. I treat them like family, and I want them to be successful by building wealth in their homes. So it depends on rate, depends on if you're paying mortgage insurance, depends on if you want to take cash out to pay off credit card debt or something like that. Probably makes sense to do it. But or take cash out your remodel or fix up your rental.
I think you've used a payoff period as a rule of thumb with me, right? When we've refinanced, we've talked about okay, well, how long is it going to take me to pay off what the fees are, the expenses are of doing this transaction to refinance? How much am I going to save enough each month to pay it off in 2 years, 3 years? I think was kind of what you.
I mean, typically it's less than 4, but really it depends on all those factors, right? It depends on what rates are doing. It depends on how long are you going to have the property. If you're going to have it just another couple of years, don't waste the money to refi. But if it's a long-term rental property and you're, 30 years, then yes, that's the thing. There's interest savings and there's payment savings. And interest savings become really big if payment savings are what people see, but they don't really see the interest savings over 30 or 15 years. And so
there are different ways of doing it. There are different ways of saving money too. I mean, you put us in a 20-year loan when we refied because when I think we were probably at 25. So we're 5 years into a 30 when we refied, and you put us into a 20 because the rate was good and we're paying it off faster. And overall, we're just building wealth that much more quick. We're spending less money on interest over time. So there are lots. Lots of different things.
The numbers are astounding at how much interest that saves over cutting 5 years off, right? Yeah.
And we're not very far off of it at this point. So 20 years goes fast.
Yeah. It's hard to believe. You've been in that house how long now?
That's our rental. That's the rental.
Oh, that's the one. Okay. Yeah. Gotcha.
Yeah. Okay, where do we want to go from here? Do you want to tell us what's happening in the industry right now on May 8th, 2025, Justin?
Yeah, May already, huh? Yeah, I wish I had a crystal ball and could tell you what I know was going to happen, but, they've been expecting rates to come down for the last year and a half. They have not, but we are definitely headed into a recession. When California goes into a recession, the rest of the nation does because they're 18 to 20% of our GDP and gross domestic product. And so California's really been in a recession since October of last year. So I do anticipate rates will come down. Yesterday, the Fed said they're waiting to drop the rates. And again, those rates are, rates at which banks lend to each other. Those aren't directly related to mortgage rates, but when they do drop the rates, they do affect mortgage rates as well. So I think we're heading into a not pretty deep, but a significant recession because of the job numbers and everything now. But the number one way that we get out of a recession is to stimulate borrowing. And the way that the government and the banks do that is by lowering interest rates. And housing is the number one industry in the US and the quickest way to bring us out of a recession. So I do anticipate interest rates towards the end of this year coming down. I don't know that we'll ever see the 2.5% to 3% again, but I would suggest, we get to 5.5% to 6%, somewhere in there.
Mhm.
And again, that's, I don't have a crystal ball, but that's what, would be my prediction, I guess.
So in light of that, do you suggest kind of holding off on either refinancing or purchasing property until rates get down to a certain point, or would, and trying to time it to a certain extent, or
Yeah.
would you suggest kind of just doing it when it makes sense for you? And then should rates come down, drastically or something in the
Yeah.
next several months, then just refinancing again at that point?
So that's an excellent question too. Basically, when you can afford it and get into a home is the time to get in, because there's several stats out there, but one really significant stat is that every time the interest rate drops 1%, 4 million more people get into the market to buy. That's a lot. So if you can get in, maybe pay mortgage insurance or get in at a higher rate, get the equity, and then you can always refinance to a lower rate and lower your payments. But in the meantime, you're still building equity all of those months. So I'd say if you
There
can
maybe is
afford
less
it now,
competition,
yeah,
and
and then
less
you're
competition on those places, and you
yeah,
get a better price.
The key being when you can afford it,
yeah,
right? I have to reasonably be able to expect that you're going to be able to pay whatever you're signing up to pay. I'd urge kind of being moderately conservative in making investments like this. So
agree.
Well, that's a
But
good point too. I would suggest, talking to your lender and talking to people like Justin who can kind of walk you through what you can and can't afford, because that may sort of change. Like we've sort of talked about, there's different products out there that maybe you weren't aware of that they can put you into that does make it more affordable, where you can get into it, where you might not think you'd be able to get in right now, but there's something out there that maybe allows you to. I would suggest that
Absolutely.
for sure.
yeah,
And
Justin,
along those lines, just a second, Eli, I'd say, with a primary residence, when you're buying a primary, you want to be able to stretch a little bit because you're paying rent and then the payments probably are a little higher. But I'm not a person that's going to get you qualified on a rental property and push the limits, because, I don't want you having headaches or cursing me out when, every month you have to make that rental payment, because you've got to, primary is the first. That's where you build your wealth and then be able to buy rental properties like we've all done. And that's the most important thing. But yeah, I'll advise you along those lines too.
So do
Well-
lenders generally take into account a certain kind of vacancy rate that they just build into their projections when they're approving you or not?
Yep. True. So it's 75%. So whatever the rent is on, that unit, they only take 75% of that for qualification.
So that is fairly conservative just right off the bat.
Yeah.
So Justin,
And again, exactly.
maybe I hope this doesn't ask you to step too far out of your comfort zone, but if you're borrowing on a larger, I think you don't lend on anything above 4 units, right? Because let's start on that. That's a different category of loan where you have more than four units in a multifamily, right?
Correct. It's considered commercial, right?
Considered commercial. So who lends on that? What are kind of briefly some of the differences in qualifying for those loans and rates and stuff like that?
Sure. So I don't know quite as much about commercial loans, and I do have people that I can refer out to for that. But typically those loans because they're commercial, they take anywhere from 6 to 8 months to get done. Sometimes 4 if they're quick. On residential, we close within 30 days. That's always our goal, or, even quicker than that. But we can do that typically. There are just a lot more factors considered with, like say a 20 unit building, because if something goes wrong for the outside of it, the fixing cost is a lot greater than it would be for a 4 unit building. So they go in a lot deeper levels and more levels on a commercial loan. And I would just say get a good commercial loan rep to help you out with that, because they've done a ton of them and they can walk you through it and come up with the numbers at the end and see if it makes sense.
And to some extent, the property ends up having to qualify for the loan as much as the borrower does. And isn't that right? I mean, it's
Correct.
there's more scrutiny on the property than there is if you're with kind of conventional residential lending.
Absolutely. And typically in the commercial, there's more down required as well, from my experience, what I've heard. I don't know.
Yeah,
for sure.
30 or 40 or more.
Yeah.
Often. Yeah.
Yeah. And the prices are much higher because of the number of units available. Yeah.
Mm-hmm.
And also on those, I do know that whomever is buying has to have good assets in reserve after it's closed. So,
Right.
Yeah.
And a strong track record of being an investor, a landlord, or
A landlord, correct.
Yeah. Yeah. That will help and is maybe even required, is my impression. Kind of need to have that.
I'm not sure, but I would
experience.
imagine. Yeah. I would imagine in this case. So,
Okay. So if you are a first or second time investor looking to buy a rental property, anything we haven't talked about that, somebody should know or consider?
yeah, I think just going back to the point of you guys talking to somebody that is a lender or a rep that can get you qualified, make you comfortable on what rates are currently, what we use to qualify. But when you go out, it just makes things a lot simpler when you're dealing with your real estate agents or whomever, properties anyway, especially on, 4 units, and make an offer if you don't qualify. That just makes everybody look bad. Plus it's a waste of everybody's time. So getting qualified is the main thing, kind of knowing what rates are, knowing what your payments will be on your new primary or rental property. That's a big deal so that you can feel comfortable with that too. And just basically knowing everything before you go in. So.
Right. I'm a big believer in having somebody like, preferably Justin or somebody like Justin to talk to as part of the process so that you really understand what you're getting into. Don't get out there and start making offers that you can't come through on because you haven't, you haven't done your due diligence.
Yeah. And there's what I would just say to work with somebody you trust, work with somebody that somebody knows or is referred to you, because if you're going to big banks or call centers and stuff like that, you're not ever going to be working with the same person. And like, I've known you guys for quite some time. I treat every client the same way. I want them to be able to call me any hour of the day and say, any hour of the day, hey, I've got this question. I didn't think of this, whatever, it's important that I get back to them within an hour, but really you work with somebody you trust, because I'm not just here for one transaction. If you get 4 or 5 properties, I'd love to do them all for it and help you out. So,
and you're in there in the process with the realtor too, a lot of the time.
Correct. Big time.
We don't go into the story, but my primary residence, we had to figure out ways of, it was kind of a distressed property and both new and our agent, jumped through some hoops to get us there, and it wouldn't have happened without kind of that concerted effort and teamwork. So
agreed. That was very unique. It worked out well.
It did.
So, yeah.
Great.
So, yeah.
All right. Well, I think that's a good spot to wrap it up. But thank you, Justin. Again, everybody, we're talking to Justin Buehring with Highlands Residential Mortgage, and we'll put his contact info down here in the notes so anyone can reach out to Justin if you've got any questions about the lending business, or if you need to find something yourself and you're here in the Seattle or greater Seattle area. And if you're not, you might be all over Washington. And if you're not, I'm sure that Justin can point you in the right direction as well. So thank you again. And, remember to like and subscribe and do all the things so you get notified when the next episode comes out. You can hear more stuff like this. So if you have any questions, let us know. Send it in the comments as well.
Thanks, Chris and Eli, for having me, guys.
Thanks, Justin.